Alrighty. Welcome, everybody. Welcome. And thank you for joining me on this very timely webinar. We obviously have a lot to talk about over here. A lot to talk about, a lot going on in the market. I see that the room is filling up, so I'm just going to give it a few more moments for people to enter. All right, to see people are entering. It's good stuff. All right, fantastic. Great to connect with everybody. Thank you so much for joining me on today's very timely, very important webinar about market volatility. Market volatility. This is definitely interesting time for federal employees. Federal employees are being hit with a double whammy. Not only is there talk of reductions in force where people may be losing their jobs, but also the stock market is cratering. And obviously, people are very concerned. I'm getting phone calls, I'm getting emails, and I'll share with you some of the sentiments that I've been encountering, some of the actions that my clients are taking, and some of my thinking about the overall scenario. Before I dive in, I just want to mention that this class does not happen in a vacuum. As I mentioned in all my webinars, these classes happen because I'm being supported by my clients and by my members. So if you know somebody who's a client or a member of mine, go give them a hug, say thank you from all of us. And if you would like to become a client or a member, I'm actually going to give you guys a link in the chat box. So if anybody here is interested, you could request to meet with my team, and we can help you talk through your financial goals, financial planning. You could talk about your portfolio as well. I'm going to share with you guys a link in the chat box. Here it comes in the chat box. I'm hoping you guys can see that link right over there that I just pointed in the chat box. Okay, fantastic. And I'm also going to post that link in the sidebar. So if you guys are interested, you can see the link in the sidebar. I just posted it over there as well. This way, if anybody here is interested in talking one-on-one with my asset management team, we could get into whether what you're doing in your TSB, whether what you're doing in your portfolio is the correct thing to do. We could have that discussion. Just click on that link and submit the request for the meeting, and we will try to get you in as quickly as we can. Okay, fantastic. So let us dive into today's class. I do want to frame that what President Trump is doing with this whole tariff war, which is obviously the focus of much of the market chaos. I wouldn't say much. I would say the entire market chaos is a result of this Trump tariff war. I will say that not everyone is in agreement with what Trump is doing. I mean, obviously the stock market is not in agreement, but we will hear that there are major investors, not just major investors, but major conservative, Republican, Trump supporting investors that are against what President Trump is doing. And the reason why they're against what President Trump is doing, as we will see, is because well, actually, let me not say that they're against what President Trump. They are unclear as to what President Trump is doing, and as a result of that, they are looking for some clarity from the president as to why he's doing what he's doing. As we will see, there are a few motivations for Trump to be doing what he's doing, and we will just have to question whether or not those motivations make sense to you, whether they make sense to anybody else, and ultimately whether it makes sense to the investors, because at the end of the day, the stock market is just going to be a reflection of investor sentiment. So let me go through some of Trump's, some of the investors that you're very familiar with, and also some of the Trump supporters that you're probably familiar with, so you can see their take on tariffs in general and specifically what President Trump is doing. So let's start with Warren Buffett. So Warren Buffett was recently interviewed, and he actually said tariffs are an act of war to some degree, right? And he doesn't feel too good about having a trade war with other countries. And I'll show you guys in just a few moments, in a few slides, what exactly this tariff does in the trade dynamic with other countries. But the first thing you'd have to hear is Warren Buffett's words that that tariffs are an act of war. That is a pretty boding statement. It's a really scary statement to hear those words. Now, it's not just Warren Buffett. Elon Musk, also, everyone's familiar with Elon Musk, and Elon Musk is not a favor of these trade wars either. And here's what he shared. He said, at the end of the day, I hope it's agreed that both Europe and the United States should move ideally, in my view, to a zero tariff situation. So essentially what Elon Musk is saying is that he hopes the end goal is zero tariffs. Now, we're going to have to keep that in mind because that's unclear whether or not that is the end goal. If that is the end goal, then the results will go in one direction. If that's not an end goal, then the results will go in a different direction. So we're going to have to talk about that in just a few moments. So that is Elon Musk. Also, Trump supporter Bill Ackman. So here's a long quote from Bill Ackman. It's actually a few pages long, just so you guys can to be braced. That Bill Ackman has laid out what he feels is a very sharp rebuke as to what's going on with President Trump. And again, this is a Trump supporter. The country is 100% behind the president on fixing the global system. But business is a confidence game, and confidence depends on trust. Trump has elevated the tariff issue to the most important geopolitical issue in the world, so he has gotten everyone's attention. So far, so good. So again, what's so far so good? Meaning, if you're getting the attention, why is that good? Why is the attention good attention? So as we'll see, it really depends on the end goal. What is the end purpose of these tariffs? And then Bill Ackman points out, other nations have taken advantage of the U.S. by protecting their home industries at the expense of millions of our jobs and economic growth in our country. So he's pointing out one of the benefits that other countries have utilized tariffs for is to protect their home industries. And again, it's a question as to what the end goal is of this tariff game. So far it is that we're being taken advantage of. Other countries are protecting themselves. Why are we not protecting ourselves? So we're going to hear some of this sentiment. But let's go a little bit further with Bill Ackman's quote. But by placing massive and disproportionate tariffs on our friends and our enemies alike, and thereby launching a global economic war against the whole world at once, we are in the process of destroying confidence in our country as a trading partner, and as a place to do business, and as a market to invest capital. Okay, so this is a very interesting point that he's making, which is that people may not be interested in our market anymore. Okay, so we're gonna have to talk about the role of the American market in the global economy. So this is going to be a little bit of a macroeconomic conversation we're about to have, but we're going to make it practical as well, and we're going to get into what you should do as investors. Bill Ackman continues, the president has an opportunity to call a 90-day timeout, negotiate and resolve unfair asymmetric tariff deals, and induce trillions of dollars of new investment in the country, which, by the way, I'm sure you've heard. I mean, I hope you've heard that the headlines are that there are some countries that are making major economic investments in the United States of America. So there are other countries that are relocating some of their manufacturing to the United States of America, and that is assumed to be overall a positive for the country. However, it goes further. This is Bill Ackman. If, on the other hand, on April 9th, which is today of all days, if, on the other hand, on April 9th, we launch economic nuclear war on every country in the world, business investment will grind to a halt. Consumers will close their wallets and pocketbooks, and we will severely damage our reputation with the rest of the world that will take years and potentially decades to rehabilitate. Okay, so that was the end of that quote of Bill Ackman. There is another quote from Bill Ackman, which is as follows. It does not help our country and our president's negotiating position to be trying to strike deals while our market is collapsing. Whoever is recommending that idea to President Trump should be fired now. Okay, so this person is Bill's taking a very sharp criticism here. He is saying he recognizes that there's an imbalance going on. He recognizes there's something unfair. He recognizes that there's a benefit to tariffs. And again, we have to see what that benefit is. But he is saying that the way we are going about doing this, we are tariffing not just enemies, we're tariffing even our allies. And we're doing it in the middle of, we're trying to hold this as a negotiating piece while our economy is faltering. And that's going to be a question as to whether or not the economy is in fact faltering. So he feels that this is unconscionable and action should definitely be taken. So as you can see, that this is something which it's not just that the Democrats are against, although the Democrats seem to be very, very excited about this because anything that will take down Trump, they're very, very excited about. But even the Republican supporters are not supporting a tariff agenda which doesn't align with what they understand tariffs should be used for. So let us talk about Trump's policies in general and the one policy that in specific that this whole class is based upon. So everybody's noticing the market going down, and the market is going down because of one of Trump's policies, which is the tariffs. But we're probably not even noticing anymore some of the other things that are going on. So, for example, there are the Trump tax cuts, which are scheduled to expire at the end of this year. And one of the things that the Trump administration wants to do is he wants to make his tax cuts permanent. So he introduced lower taxes. Those lower taxes will expire at the end of this year. And if they expire at the end of this year, that's also going to be economic pain for the Americans. So obviously, Trump has said on his agenda that he wants to lower taxes permanently, make the Trump tax cuts permanent. And that is something which he needs all the leverage in the world to pass that big, beautiful bill, or whatever words he wants to use, to lower taxes. So that's one of the things that he wants to do. And that would actually be a very good thing in general, not just for individuals, but as we will talk about soon, there's also the possibility of lowering taxes on corporations as well. And as we will see, that plays into this whole tariff war as well. Another one of Trump's policies, which nobody's even paying attention to, is energy independence, right? As he would say, drill, baby, drill. The idea of not relying on imported energy, becoming energy independent. So this is bringing jobs back to the United States of America. And also it helps us control the cost of energy going forward. And in fact, if we produce enough energy, we can even export energy, which will also be a source of revenue. So again, that's a good deal. Deregulation, taking the handcuffs off businesses, making it easier for people to do business. In general, that's a good thing. Secured borders. I think most Americans are interested in having secured borders and illegal immigration cut. Also, even government waste, fraud, and abuse. Now, nobody likes losing their jobs, and so that's a question as to whether or not that's what the government's doing. But on the other aspects of DOGE, which is cutting any waste, fraud, and abuse, I think most people would be receptive to cutting waste, fraud, and abuse. So all those are very, very positive policies. And then there's tariffs. Nobody even notices any other things that Trump is doing, which, if you'd ask me what Trump is doing with the tariffs, because it is drowning out all the other things he's doing, it's almost like political suicide. Nobody's even paying attention anymore to anything positive doing, because at the end of the day, the market is down 15% or 18%, whatever the number is today. I'm not even sure. Today, I think it started off up and then went back down. It's already a couple of hours in. So nobody's even paying attention to these things. Nobody's paying attention to all the other good policies. And there's a good reason for that, because their wallets are hurting. When you talk about secured borders, illegal immigration, so that's not the type of thing you feel on a moment-to-moment basis. But when you see that your portfolio is down, that's something you could see on every day. You're checking the market. So that's something you see and emotionally feel every single day. So it's a really, really a big question mark why Trump is taking such a serious move when it comes to tariffs, when it means overshadowing everything else he's going to do. So we really have to get into what is his thinking. Why would he do this? Why would he commit this political suicide, which is clearly tanking the markets? Nobody's paying attention to any of the good stuff. There's only this one thing and one thing only, which is the tariff and the market collapsing. So why is he doing it? So there are three explanations as to why Trump will do this. Number one, to protect important industries. So for example, if our military was reliant on foreign materials, that would not be a good thing. We need to have a military that is completely independent. We cannot be reliant on other countries. So by basically saying, you know what, we're not going to import steel. We're not going to import semiconductors. We're not going to do it because these things are too critical for the infrastructure of America. Okay, so we could sort of understand why he would do that, because we do not want to be dependent. We don't want our military to be dependent upon things external to our country. That is understandable. Then there's another benefit to these tariffs, which is he wants to level the playing field. Right now, there are other countries that have tariffs, or if they don't call it a tariff, then it's some form of tax that they impose on American goods. And Trump wants to make sure that America is getting treated, I guess, equally. I guess that's the word, equally, or at least fairly, given the opportunity to sell their goods on other markets. So if Trump could use this as leverage to negotiate the taxation of American goods imported to other countries, that would actually be a boon for American industry, because this way, Americans to sell their products to other countries won't mark up those products, which will make those products more attractive to their consumers. So that's going to be a benefit to American industry as well. So the first one, even though it's going to be expensive for America to protect certain industries, but it's certain industries, and those industries are critical to the function of America and to the protection of America. So we can sort of understand why he's doing that. The second one is also critical to America, which is that if you want to make America's production more valuable on the world stage, so very simple, just get the other countries to lower their taxes, lower their tariffs on American goods, and that will make America more competitive in other economies. That sounds like a good thing as well. The last thing, which sounds good, but really is the most dangerous one, is just a general idea of increasing revenue to the United States. Because at the end of the day, anybody who wants to import goods into the United States, they're going to have to pay this tax, or rather not the country that imports it, but rather the importing company. So for example, let's say you have the European Union wants to import some goods to America. So whoever is importing it at America, not the European country, but whoever the American company, that is importing these goods, they're the ones that are going to have to pay that tariff. Now, we're going to have to explain why that last bullet point, even though it sounds good to increase revenues to the United States of America, because now we have these taxes being paid. However, as we will see, that's not really so wonderful for the United States of America, and that could be the biggest problem in this tariff strategy. So let us explain the dynamic of tariffs. And again, I'm doing this because I want you guys to understand that this is not just tariff good, tariff bad. Okay, this is more like, let's understand, why are tariffs good? Why are tariffs bad? By the way, before I go further than this, let me just make an aside. There's a quote attributed to Eleanor Roosevelt. I don't know if you guys have ever heard this quote. It's attributed to Eleanor Roosevelt, which is as follows: that small minds talk about people, medium minds talk about events, and big minds talk about ideas. So again, small minds talk about people, medium minds talk about events. Medium minds talk about events, and then big minds talk about ideas. So in this conversation, I don't want us using our small minds and say Trump good, Trump bad. Because now we're just talking about people. Trump good, Trump bad. I don't like when people talk that language. And by the way, the same thing when it comes to Republicans good, Republicans bad, Democrats good, Democrats bad. That's talking about people. That's really small-minded thinking. That's not going to help you really much in life at all. So the small-minded thinking, I'm not interested. Even the medium mind is talking about the event. The event is tariffs, trade wars. Okay, so just saying tariffs, trade wars, tariffs are good, trade wars are good, tariffs are bad, trade wars are bad. That's not really getting into the idea. That's a medium mind, and even the medium mind I want to push aside. I want us as investors to be using the big mind. The big mind talks about the ideas, not the events, not the person, the ideas. Why are tariffs good or bad? What's behind it? And let's explain the tariff dynamics with our big minds, at least as big as we can get. We're not economists. I'm not expecting anybody here to be an economist, but at least try to understand it to whatever level we could understand it. So starting point, who pays the tariffs? So for example, Trump says there's going to be a baseline 10% tariff on all countries. Who pays that? So for example, Israel is a 10% tariff. Does Israel pay the tariff? No, it's not Israel who pays the tariff. It's the importer who brings those goods to the United States. So that could be an American company, whoever it may be. It's somebody on our shores. They import the goods. They're the ones who have to pay the tax, okay, pay the tariff. However, everybody knows that if that importer has to pay more money for the goods, so instead of paying $1,000, now they're paying $1,100 because that's a 10% tariff. So that importer, they're now paying $1,100 for goods that they used to spend $1,000 for. So it's 10% more expensive for them. What that importer is likely going to do is going to say, you know what? Why should I pay that 10%? Let me pass it along to the consumer. So basically, Who pays the tariffs? It's the importer, but really the importer just passes along that higher price to everybody else in the consumer chain. Fine. Now, the next bullet point. Because of increased pricing, consumers will now consume less imported goods, obviously, because you used to buy your phone for $100, now you're buying it for $110. So it's more expensive. So because it's more expensive, you may say, hey, can I get a better deal elsewhere? So you're going to be looking around for better deals because you see your prices of these specific goods have gone up. So you're going to buy less imported goos. But the only way you're going to buy less imported goods is if you could buy that same product domestically for less expensive. So that's a big if. Domestic goods. Can we make that same phone in America for cheaper than we could if we imported it from the other countries? And the answer is obviously we can make it at a certain price. Whether that price is cheaper depends upon how much of a tariff we're levying on other countries. Fine. Next bullet point. If domestic goods can be less expensive, hey, that's a great thing. Now, consumers are not going to be looking to other economies to support themselves. They could just be staying in America. In America, the American goods themselves could support the demand of what Americans want. They want their cell phones, they want their TVs, they want their tires, they want their lumber, they want their wheat, they want their eggs, they want their gasoline. They want all these things. And if I could get those same exact things cheaper in America than I could from the imported stuff, then fantastic. Then that's going to drive up the demand for domestic goods, which will increase production in the United States, which is basically going to increase jobs in the United States as well. So that is fantastic. That sounds really, really good. But the big question is, can everything be produced in the United States for cheaper? I'm sure some things can. I'm sure some things cannot. I don't know all the economies, all the products out there. I'm sure some things can be created for cheaper. Other things are not going to be created for cheaper. So that's the big question, which is, can we create the same stuff in America for a cheaper price than we could if we had imported those things? That's the major, major question as far as tariffs are concerned. Now, that's all of the dynamic within the United States. Then there's the dynamic outside the United States, the international trade dynamics. So the America is the largest import consuming country in the world. Okay, we buy stuff. That's what we do best. We are the best buyers of stuff. We are such good buyers that even though we have a population that is like a quarter the size of China, or whatever our population relative to China, China is a gigantic population. However, our import consuming is 25% larger than China. Isn't that a major thing? That and China is the next person in line. So we're the largest import consuming country. China's number 2, and the third one is like a far distance. So America, even though we have a much smaller population, we are consuming so much in the world. Now, if you think about that, that makes us a consuming market, which any business will want to participate in. I mean, ask yourself, if you have the chance to open up a shop, you can open up a shop in the middle of nowhere where nobody ever does business, or you can open it up in Union Station, Washington, D.C., which has millions of people going through there every single day and buying stuff. So you would say, hey, I would love to be in Union Station. I would love to be there because that's where people are. That's where people are buying stuff. So I want to participate in that market. Now, if someone told you, okay, but in order to participate in Union Station, you have to pay a higher rent, so to speak. You have to pay a larger fee to get into that market. So you'll have to do the judgment call. Is it worth it for them to pay the higher rent to get into that market? Okay, that's going to be the question. Now, if countries want to participate in the United States economy, then they may be interested in paying the tariff, but it's only worth it to them if the imports stay the same. If Trump levies these tariffs, and now basically people are less interested in international goods because international goods are now more expensive, so people are not going to buy those international goods anymore, so that's going to decrease the demand for international goods, for imports. So that's the question we have to ask as well. Will demand for imports decrease with the tariffs? It may very well decrease. However, as you can see in the third bullet point, some countries want to participate so badly in the American economy, so badly in this marketplace, which is the largest consumer in the world, that they are willing to step to the table and negotiate. And as we saw, negotiation may be a great thing. And we'll see that a little bit more in just a few slides. Okay. Now, let's understand that, as I mentioned before, who pays the tariff? The importer. And they pass it along essentially to the end user, which is us. We're the people who are going to be paying the price. As a result of these tariffs, our goods are going to go up unless we could find the production in the States to make it for cheaper. Okay, so that's really the issue over here. So essentially, it's an extra price levied on the importer, which can be passed along to us. If you guys are following what this means, essentially what a tariff is someone's paying a tax. The importer is paying a tax, and he's paying it, and he's passing it along to the consumer. But the importer is paying a tax on those imported goods. And this gets into the constitutionality as to whether or not a president has this ability to impose a tariff, because at the end of the day, a tariff is a tax. And it's a tax. Some people actually call it the largest tax that is ever going to be imposed upon the American people. So can a president of the United States just come along and willy-nilly say, hey, I'm imposing a tax. I want everybody here to pay higher goods for imported stuff, higher prices for imported goods? That's really a question if whether a president could raise the taxes like that. By the way, if the president could raise taxes unilaterally, just by himself, I'll just do what I want and I'll raise taxes. Well, guess what? The president should also be able to lower taxes. But we all know the president can't just lower taxes by himself. He needs the approval of Congress. He needs the vote of Congress to lower taxes. So the question really is, how does a president even have the legal authority to do these tariffs when, if essentially it's a tax, shouldn't you need the vote of Congress to impose a tax? And that's one of the things that's being debated right now, whether or not the president has the ability to impose these tariffs. Okay. However, let's be very honest. It is a tax. That's what it is. And the tax may discourage business. Well, I have news for you. If you wanted to encourage business, you could either lower the tax, or let me give you another option. Another option is, why don't you just lower the tax on businesses that do business in the United States of America? So, for example, there are many companies that they set up their they set up their businesses in other countries, and the reason why they set up their business on other countries is very simply because other countries have a lower corporate tax rate. So if they're going to be paying taxes, they'd like to go to the place that has the lowest possible taxes. That's just the nature of business. Everybody wants to pay as low taxes as possible. So if Trump really wants to invite investment in the United States, the way you invite investment into the United States may actually be not imposing a tax on imported good, but cutting the corporate tax to companies that set up shop in the United States. If you cut that tax, so then countries will say, or companies would say, excuse me, that, hey, I could just set up shop in the United States and I'll have a lower taxation. Fantastic. They would much rather do that. That's going to invite companies into the States. That's going to bring in jobs to the United States. So that sounds like a very, very good idea. And I think most people on the conservative side of the aisle would actually agree that that would be a great deal for the United States as opposed to imposing these tariffs. Okay. Anyhow, we mentioned before early on that Warren Buffett said that tariffs are an act of war. Because now you're basically saying, we're not doing business with you. Or if you want to do business with us, you have to pay us a hefty fee, or somebody else has to pay us a hefty fee in order to get into our marketplace. So that sounds like an attack against other countries. However, let's be very, very clear. Many countries already are tariffing American goods. So that means for many countries around the world, America is not starting this war. Trump is not even starting a tariff war or trade war. There are already trade wars in existence. And when we say trade wars, there are some countries that don't have a tariff, but they still have some sort of sales tax on American goods. So even though it's not a tariff in the official uses of language, there's still some trade barrier. And that's what Trump is also trying to level as well. He's trying to remove the trade barrier. So remove your tariffs, remove your taxes, make it that there's no trade barrier for the United States to do business in your country. And then we have what to talk about. And that sounds like Trump is somewhat receptive to having those types of negotiations. If you remove every single trade barrier for us to do business in your country, then we could reciprocate and remove the trade barrier for you doing business in our country. Okay? So I think this is what Elon Musk was saying earlier. Elon Musk was hoping that we go to a zero tariff regime, a zero tariff regime with the EU and probably with other countries as well. He wants to make sure that we have no tariffs at all. And it could very well be that's Trump's agenda as well. But again, we don't know what Trump's agenda is because no one's really telling us what Trump's agenda is. So let's go back to the possible agenda for Trump, and we'll talk about whether it's good or bad. And then depending upon whether it's good or bad, we're going to tell you what to do with your investments or not. So what is the end goal of Trump's tariff war? Again, it's just raising the prices on imported goods. Can America produce those goods for cheaper? That's to be seen, right? Other countries, if they're not going to be doing business with the States, so they're going to be suffering because America is the biggest consumer of their goods, or of most goods in the world. So these countries may be suffering themselves as well. They may create trade alliances with other countries, which would not be good for the United States of America. But again, if they're willing to make trade alliances, why don't they just make a trade alliance with the United States of America? So I'm not sure if really it's such a terrible thing as far as the negotiating technique. So here are the three end goals of the tariff, as we mentioned earlier, and we're going to go through each one of them to see what you should do in response to them. So the first end goal of the tariff, as we said earlier, was to protect industries. So for example, semiconductors, steel, those types of things, those are important industries. America runs on, America's military and important infrastructure runs on these industries. So if that's the case, then these Trump tariffs should really only impact those specific industries. It should not be a global tariff war. It should just be tariffs on specific materials, specific production. This way we protect our interests in America. The fact that Trump's tariffs seem much broader than this would suggest that this is not Trump's interest to protect important industries. If it was just to protect important industries, that would have long-term pain just for those industries, because, for example, steel would now be more expensive if you import it. So that's going to be obviously painful for the steel industry. I mean, it'll be good for the American steel industry if they could lower their prices, but if not, then it's still going to be painful for the steel industry. It'll be good for semiconductors. In America, if America produces semiconductors, that'll be good. But as we all know, semiconductors are primarily produced outside the United States of America, so that's not going to be good as well. But it's going to be painful for just those industries. The steel, the semiconductors, those are going to have higher prices, but it really shouldn't affect anybody else. But as we just said, Trump is doing something that is much broader than specific industries. He's doing broad countries across the entire broad tariffs across the entire countries. So therefore, it seems to be that the first one is not really a concern for us. If there was the first one, it'll be long-term pain for those industries, and it'll have a short-term effect, or shouldn't affect at all, the other industries. But that's not what's happening. Let's go into the second bullet point. The second bullet point is that the reason why Trump is doing these tariffs is because he wants to leverage trade deals. He wants to bring us to a zero tariff situation, which is what Elon Musk said he was hoping for as well. And if it does leverage trade deals, so that's going to be some short-term pain. The reason why it's going to be short-term pain is because the assumption is that when everybody starts feeling the ripple effect of these tariffs, they're going to be willing to step to the negotiating table, and they're going to be willing to make it into a level playing field between the United States economy and other economies as well. If that is the end goal of the Trump tariffs, so then we're going to have short-term pain. We are. Until we start hearing the deals coming, we're just going to have short-term pain. And by the way, has anybody here noticed, I'm being very serious, has anybody here noticed how the market is literally reacting in real time to President Trump's tariffs announcements? For example, when he announces a tariff on China, the price goes down, or the stock market goes down. However, when he announces that there's some trade deals being negotiated with Japan and some other countries, so then the market, on that very announcement, it goes up. And I think today the market, started off up because there was some good news about tariffs. What I'm trying to say to you guys is that the news on Trump's tariff policy is having a direct impact on the stock market. And the market will go down so long as there's bad news, and the market will go up when there's good news. Now, do you know when the bad news is going to hit? No. Do you know when the good news is going to hit? No. We have no clue when the bad news is going to hit. We have no clue when the good news hit. I don't know when Trump is going to strike a deal with any country. I don't know when that's going to make it into headlines. I have no clue. What I do know is that when that good news does happen, the market's going to go popping back up. So that type of thing of, I don't know, the market's looking scary and Trump is talking crazy talk, and so I want to get out of the market, for a real time. I'm just letting you know that, yeah, this may be a short-term dip, but it may bump back up tomorrow, the next day, the next week. This may be really, really short-term, in which case, if you got out of the market before anything went down, then good for you. But if you're the type of person who, like the rest of us, is in the market as it goes down, which, by the way, I'm also in the market, just me personally, just so you guys know, I'm also in this stock market and watching it go down, and I have not sold my positions. So I let the market go down, and my assumption is that the stock market will eventually come up. Now, will it come up in the short term or the long term? I'm going to talk about that in the next slide. But the idea is that for those who have been holding it while the market has gone down, already your portfolio has decreased in value. If you sell at this point, you're going to be locking in losses, which, by the way, locking losses, you may be okay with that. But my point is, if the very next day Trump announces trade deals, which that could happen, that literally could happen this afternoon, it could happen tomorrow, that he announces an amazing trade deal, the market is going to come back, you already locked in your losses, you're not participating in the recovery, so that's going to be a very unfortunate reality. Okay, let's now go to the last one. If Trump is imposing these tariffs, but it's because he thinks that tariffs are good. The reason why he thinks tariffs are good is because tariff raises revenues. All these tariffs are going to have to be paid. That's going to bring in new money into the United States of America. So if he feels that tariffs are good because it raises revenue in the United States of America, so then I have news for you. He may not be interested in negotiating deals. Because why would I negotiate deals? I'm losing all this tariff revenue. I shouldn't negotiate deals. I should impose these tariffs and let those tariffs last for as long as possible because it's increasing revenue to the United States of America. If that is Trump's end goal, to increase revenue to the United States of America by imposing these tariffs, that unfortunately is not going to be solved in the short term. Because even if countries come to him and say, listen, Trump, we will go zero for zero. If you remove all your tariffs and trade barriers, we will remove all our tariffs and trade barriers. We will go literally 0-0. Trump may say that, no, you don't understand. I don't want to negotiate with you. I like tariff revenue. Tariff revenue increases money for the United States of America, and that sounds really, really attractive to President Trump for reasons that are beyond me. So if that's his attitude, that he does not want to negotiate deals, then we have some longer term pain until the markets stabilize and take this as the new norm. We may have a downturn economy for quite some time. It may not just be a matter of weeks. Even if everybody comes to the negotiating table, this may take months. This may even take years for the economies to stabilize. Now, when it does stabilize, then it'll just be business as usual. And by the way, let me remind you, it may stabilize either by the midterms or may stabilize by the next president election. But if this trade war has not reconciled itself by the next election cycle, it could very well be that this is what I mentioned earlier. This was just complete, unforced, unnecessary political suicide by the Trumps, and not just by Trump, but also by the Republican Party for not stopping this from going forward. So again, what is Trump's end goal? Is it to protect industries? If he does, I'm fine with that, okay? And that really should not cause long-term pain in the stock market at all. If it is to leverage trade deals, I'm fine with that as well. And again, that should not take long-term pain. That might be short-term pain until we hear of the deals happening. We're going to see people, nervous. But once he expresses that he's open to negotiations, we will see the market hopefully respond favorably to that. And certainly once he does negotiate and walk away with good trade deals for the United States, then the market will respond favorably to that. So the first two bullet points are actually short-term pain. And if it's short-term pain, then it's the type of thing which it could be tomorrow your portfolio recover, and it's as if you just had a short, you went to the doctor, you got a shot, and now you're back on track. However, if it's the third bullet point, that is probably the most concerning. But even in that third bullet point, the one that's most concerning, it is going to be long-term pain. When I say long-term pain, it might take a year, 2, it might take 4 years for this thing to recover itself. That would stink. That would absolutely stink. That would be absolutely devastating. That would be absolutely devastating. But you maybe hear what I'm trying to say, which is that even if it does take until the next presidential election to undo this, what's happening, okay, so when there's a next presidential election, we will undo what happens, and then hopefully the American economy will recover again. So this is the type of thing which I think the American economy should see recovery even, right? I think it's going to be less than 4 years, but by 4 years, by the next presidential election, we should already see some recovery in the economy, unless the next president keeps the Trump tariff game going, in which case it might be longer term pain than that. So I don't know what to say about the last one, although I do feel that even if the last one does happen, with the next election, it'll be resolved. So with all this being said, let me remind you of one of my favorite quotes of Warren Buffett. Okay, this is one of my favorite quotes. I share this with all my classes. I really want you guys to keep this in mind. This is a very, very important quote to keep in mind. He says that the stock market is a device that transfers money from the impatient to the patient. That is a great quote. Listen to those words again, because it's really, really indicative of what's going on right now. The stock market is a device that transfers money from the inpatient to the patient. Anytime you see a drop in the stock market like you're witnessing right now, there is a transfer of wealth taking place. And the question I have for you is, which end of the transfer would you like to be at? If you are the patient, and what does that mean, the patient? Means if you give your investments time, time is the ultimate risk mitigation when it comes to investing in the stock market. I know if you guys have heard of all these different risk mitigation strategies that people have. So some people, they use bonds. Some people have moved everything to the G fund, which, by the way, just this morning, you have to hear this, just this morning, I got an email from a client. Now, this client, him and I, we spoke about what his portfolio should look like. And I told him that for the next 10 years, the amount of money that he needs from his portfolio equals, I forget the number, it's like $250,000. That's all he will need from his portfolio for the next 10 years. And I told him that that $250,000, that could be secured in the G fund, because everything else could just be participating in the market. The market may go down, but it also may recover. And usually within 10 years, usually the market recovers within 10 years. Is that always true? Is it guaranteed? There's no guarantees in investing. Investing certainly comes with risk, but it just happens to be true 97.5% of the time. Okay, I'm being very, that's not a stat that I made up. 97.5% of the time, over 10-year horizons, the market usually recovers, not only recovers from its losses, but has handsome returns beyond that. So I told this investor that all he needed was to buy himself some time. And I told him specifically, according to his projections and calculations, okay, and with their very conservative projections, he would need $250,000 from investments. So let us secure his $250,000 in the G fund. Everything else could be aggressive. So anyhow, he wrote me an email this morning, and he said, Stefan, I want you to know, I moved everything to the G fund. Everything. His entire portfolio, over $1 million. He moved everything to the G fund. That's what he did. Now, I understand that he was uncomfortable, and I was hoping to mitigate his discomfort by pointing out that you should know, even though the market's going down, the stock market going down is irrelevant to you for at least 10 years, because we set aside the $250,000 which would buy him 10 years of time. But for whatever reason, that did not speak to him. Having the 10 years of time was not enough. He wanted to have, no money, none of his money exposed to the stock market. And as a result of that, he took his money completely out of the stock market. Now, that is a surprising action. When I say it's a surprising action, I want to remind everybody, investing comes with risk. Of course, investing with risk. I mean, of course it does. If you want to invest in the stock market, just be aware that your portfolio could go down. Now, with the market going down is not intrinsically a bad thing. Remember, it's not a loss until you sell. So, for example, this year your portfolios are down 15%, maybe 18%, whatever the number may be. So, how many people here lost money in the stock market this year? And the answer is nobody did, unless you sold and you locked in your losses. It's not a loss until you sell. It's not a gain until you sell either, but it's not a loss until you sell. So really, the people here that are going to be suffering losses are the people who are not willing to give it the time. Basically, as Warren Buffett said previously, the people who are going to be suffering the losses are what he calls the impatient. Impatient means that you're not willing to give it the time. And again, how much time should it take? Well, I would assume by the next presidential election, we may have a reconciliation of this, because with the next presidential election, we may have somebody who comes in and wants to undo whatever damage the Trump tariffs have imposed. Now, again, I might be getting ahead of myself. It might not even take 4 years to recover, because as I mentioned, tomorrow Trump could announce that he is negotiating with our allies, and he is negotiating zero trade barriers at all. And if Trump announces that, the market will recover pretty quickly. So it might not require 4 years of time. It just may require time. And unfortunately, the people who don't give it time are the ones that may be locking their losses. I actually saw recently, I was reading a book, and the book made a very, very fantastic point. There is a price to capturing the market gains. Everybody wants something for the market, Okay, when you want something in the store, don't you have to pay a price for it? So, for example, if you want to buy yourself a cell phone, don't you have to pay a price for it? When you want to buy eggs, don't you have to pay a price for it? Whenever you want to get something, there's always a price you have to pay. So, let me remind you, if you want to get the stock market returns, there's a price. The price you have to pay to get stock market returns is you have to pay the price of patience. You have to be durable. You have to be the type of person that waits it out. I know everybody else has experienced downturns in the market. You've all experienced the coronavirus downturn that lasted just a few months. You've all experienced the Great Recession. The Great Recession that was a systemic issue, a massive systemic issue, and that lasted for a couple of years. So we have all experienced downturns in our careers, right? There have been Great Depressions, there have been dot-com busts, there have been saving loan crisis, World War II. We've seen all of these things come and we've seen all of them go. We've seen the markets go down and we've also seen the markets not only recover from their losses, but also go up. However, in order for you to capture the gain, in order for you to get what you want from the market, you have to be willing to pay the price. The price that you need to pay in order to capture the gains is, as Warren Buffett said, patience. Patience, wait it out, be durable. And if you are patient, then you will be rewarded, as Warren Buffett said, that the stock market is willing to reward, it's willing to transfer money from the impatient to the patient. So to make a long story short, here is what I tell my clients to do. Okay, and this is probably what you guys are waiting for, because I'm getting phone calls, I'm getting emails, people are definitely panicking. And as I mentioned to you just this morning, I had got that unfortunate email that one of my clients said that he's going to move his entire portfolio into the G fund, essentially locking in the 18% losses that he experienced, even though he doesn't need that money for at least 10 years. He said, it doesn't make a difference, Stefan, I'm locking in these losses. Okay, fine, that's what he said to me. But here's what I tell all my clients. Here's what I tell my clients. The market going down is not intrinsically a bad thing. We have seen historically that the market eventually recovers from its losses. It just needs time. So the question that every one of my clients needs to ask themselves is, do they have the time to wait this out? Now, for some of us that are still working, assuming we don't get riffed, we have the time to wait it out. We could just wait until we touch our portfolios in retirement. However, there are other clients that are saying, Stefan, I'm retiring this year. I took the DRP. I might get riffed. I might take the Vero. I'm going to be retiring at the end of this year. I don't have the time to wait these things out. My response to those clients is, yes, you do. You definitely have the time. The way you have the time is you buy the time within your portfolio with a conservative bucket. So for those who are wondering, what do I mean by a conservative bucket? If you look at your portfolio, you could take your portfolio and you could crack it into two buckets: an aggressive bucket, which is going to consist of stocks and growth-oriented instruments, and a conservative bucket, which is going to consist of the G fund, very conservative instruments. The function of the aggressive bucket is to grow. It's the growth engine of your portfolio. The function of the conservative bucket is to buy the time for the aggressive bucket to recover from its losses. So everybody here really needs to forecast into the future. And the way I do with my clients is I forecast 10 years into the future. So I would encourage you guys to do the same. You should forecast 10 years into the future. How much investment income, meaning how much money will you need from your investments over a 10-year period of time? Assuming you're retiring. If you're still working, then you won't need your investments. You're going to still be working. But if you're retiring, how much money will you need from your investments over that first 10-year period of your retirement? It could be you'll need 100,000, 200,000, 300,000, 500,000, whatever that amount is. That amount should be secured in the G fund, which is exactly what I told this client. You're going to need $250,000. That $250,000 should be secured in the G fund. Of course it should be. And that's going to buy you the 10 years of time. So everybody here, you have to figure out how much money you will need over a 10-year period of time. Secure that money in the G fund. Okay? Secure that money in the G fund. However, everything else could be given the opportunity to participate in the market. So when I say participate in the market, that means that you participate in the stocks. The American stocks within the TSB, as I mentioned, are the C fund and the S fund. Those are the American stocks, right? Some people are asking me, Stefan, what about the I fund, the international stocks? And I will say I'm not a big fan of the international fund, even though the I fund happens to be the best performing stock fund this year thus far. However, the fact that the I fund has a good year once every decade, that's not enough of a justification to be utilized in the I fund. The American economy is still the strongest economy in the world. The American economy is still the largest consuming economy in the world, even though we're not as big in population, but our what we produce and what we consume is massive. And by the way, even the American companies, the ones that are in the C fund, the ones that are in the S fund, those companies are doing business internationally as well. So when you are invested in the C fund, you are getting international exposure. So I'm fine with that as well. So let me reiterate. If you're in the market, there's always the risk of losing money. Of course, there's a risk. And there's also reward. The reward is that you get stock market returns. However, there's a price you have to pay to capture that reward. The price is you have to be patient. You have to give it time. You have to be durable. You have to be able to fend off all the fear mongering that takes place. Just go back in your mind and remind yourself what happened to the stock market with coronavirus. What happened to the stock market with the Great Recession? What happened to the stock market with the dot-com bust? Yes, the market went down, but the market going down does not mean you lost money. It's only a loss if you lock in those losses and you sell. What my clients are being advised, and what myself is doing, what I'm doing myself is, once again, giving it time. Giving it time. Time is the ultimate risk mitigation technique, and as we've seen time and time again, historically, the stock market, after time, whether it's 1 year, whether it's 2 years, whether it's 3 years, the market over time recovers from its losses. How much time will it take? I cannot say. I do not have a crystal ball. Will it take less than 10 years? It usually does. 97.5% of the time, it usually takes less than 10 years to recover its losses. Yes, it does. Okay, so I would encourage you guys to be like Warren Buffett said, be those patient investors. Right now, there's a tremendous transfer of wealth taking place. And the question is, which end of the transfer would you like to be at? If you are the ones that give it time, if you are the patient, you will be handsomely rewarded. And hopefully we will see that the end goal of this Trump tariff strategy was not just to impose tariffs willy-nilly, but hopefully it was for other important purposes that are in Americans' interest. America's interest is definitely to protect their critical industries, that's for sure. And then there's also the interest of having a level playing field, which should usher in economic opportunities, not just domestically, but also abroad as well. I see I have some questions in the chat box, and I want to take those questions. However, before I take my questions, let me just remind you of my offer to speak with my asset management team. If anybody here is interested, just click on that side button that says learn more, and you can request a one-on-one consultation with my asset management team. Now, I'm also going to post that link in the chat box for you guys to have as well. Here it comes in the chat box. Here it comes. There you go. It's inside the chat box. So whoever here is interested in getting together, just click on that link and request your consultation, and we will be happy to get together with you. Okay, so now let me turn to some questions that are in the chat box. The first question is, Sarah, is it advisable to invest new contributions to the G fund for now, or continue to buy shares in the C and S funds when they're cheaper? Oh my goodness, if you'd ask me, your new contributions, I mean, the market is down right now. C fund, S fund, this is a buying opportunity. Now, can the C fund, S fund go lower? Of course it could go lower, but we're not trying to time the market. We don't know when the top's going to be. We don't know when the bottom's going to be. And for all my clients, there's actually, there's no exception to this, with all my clients, their new money that goes into TSB, C fund, S fund, C fund, S fund. I don't have any new money going into the G fund. Okay. Crystal's asking, what is the effect of moving money from the G fund back to the stock market funds? Crystal, that's a great question. Right now, the market is down 15%, 18%, whatever the number may be. So if you had money in the G fund, you'll be moving it back into the stock market. Again, you could be buying in at the price that it is right now. Is the price right now the lowest price that it'll ever be in? I don't know. I don't know. But I will say it's not the highest price because it's already discounted by 15, 18%. I actually met with a client the other day that they were just conservative in nature. Like they were 50 stock, 50 bonds in nature. And I asked them why they 50 stock, 50 bonds. They just said, like, that's just what they did. They figured to have a balanced portfolio. And so I told them, that they actually don't need to have a conservative bucket that is 50% of their portfolio. All they need in their conservative bucket is, in this client's example, was 30% of their portfolio need to be conservative. The other 20% did not need to be conservative. So I actually told them that 20%, you can move it back into the stock market and purchase in at these discounted prices. Again, can the market go down further? Yes. Are these the lowest prices that the stock market will ever see? I can't say that. I don't have no clue what will happen. Okay, but I am telling you that it's not the highest price either, and you will be buying it at somewhat of a discount. Okay, I see Ira has a question. Historical perspective, the market didn't recover from smooth Harley tires until 1950. 20 years later, Ira, I don't know where you're getting that. You could share that information, okay, but I do not know where you're getting that. And by the way, when you say the market did not recover, I mean, just look at the stock market returns. You can see the pricing, and it should be in there. Now, Ira, if you may say that it went down and it went back up, and then it went back down, and it went back up, and it went back down. Okay, there are ups and downs. That definitely does happen. But a 20-year period of time, there has never been a 20-year period of time, at least in the S&P 500. There has never been a 20-year period of time where the S&P 500 would have ended up with a loss. There's never been. That's something that's never ever happened. Okay. I see Ira's another question. What is our baseline for deciding whether the market is down? Should we take from our safe bucket? S&P at 6,000? No. The way I determine whether the market is up or the market is down is actually relative to each client's portfolio when they retired. So for example, if you retired and your portfolio was worth, your stock portion, the stock portion of your portfolio was worth $1 million. So that's the baseline. That's the baseline to determine whether the market is up or down. So if you have two buckets, the aggressive bucket, the conservative bucket, and the aggressive bucket, let's just say, is $1 million, and the conservative bucket is 200,000, that $1 million is the baseline for whether the market is up or whether the market is down. I see Kim has a question. If I have funds in the I fund, should I move all the funds to the G fund? I'm not doing any future contributions in the I fund. I don't know if I would necessarily move them all to the G fund. I mean, Kim, this really gets into how much money should you have in your conservative bucket. Remember, the G fund is functioning as your conservative bucket. How much money should you have in a conservative bucket? I don't know. It goes by person by person. But I will tell you, Kim, the way you measure how much money you have in your conservative bucket is by measuring how much income you will need from your investments for the next 10 years or for the first 10 years of your retirement. So Kim, if you're not retiring, you retire next year, okay? So if you're retiring next year, you have to forecast how much investment income you will need for the next 10 years. That investment income should be secured. Of course it should be secured. It should be secured in the G fund. That's exactly what we do with our clients. That money should definitely be secured. And this way, you know that you have peace of mind, at least for 10 years. At least for 10 years, you have that money that you'll need for the next 10 years secured in the stock market. Okay. However, the rest of your portfolio could be exposed to growth. Yes, it may go down, but usually over a 10-year period of time, it will recover from its losses. Stan is asking, what about the bond fund, the F fund? So Stan, that's a little bit of a guess for the conservative bucket. I'll tell you why. Because the F fund will actually decrease in value if interest rates go up. And in an inflationary environment, which we may encounter, interest rates may go up to counter inflation. That's a big guessing game over there. So Stan, if you have the F fund could lose value. Remember, if the conservative bucket loses value, it's not just losing value, it's losing time. And the whole function of the conservative bucket is to buy time. So I do not want people having F fund in their conservative bucket because they'll be losing value, which is going to lose time. Steve is asking, I'm over 70 years old and cannot plan on taking TSB out until RMD is concerned. And do not plan on taking TSB until the RMDs. I have 50% of the C and S funds. Would it be advisable to go from the L 2030 to the G fund? So you have 50% of your portfolio in C and S, and then the question is the other 50%. Should you go to the G fund, the other 50%? Again, do you need the other 50%? It sounds like you don't need your money at all. Okay, you're 70 years old. You're not going to touch your investments until 75. And by the way, even when you are, or 73 actually, okay, you're 73, that's when you have your RMDs. So when your RMDs kicking at 73, even though you're forced to take that RMD, whatever you take out, you can pay the taxes on, and whatever's left over, you can just reinvest it right away. So I have news for you, Stephen, that because you don't need money except to pay the taxes and RMD, you can just take the distribution, pay the taxes, and then have the money reinvested right away, and it's really not a big deal. So I'm not sure if you don't need any money from your investments at all, Stephen, you might not need a conservative bucket. Teresa is asking, if you recently retired and will need to start making withdrawals, would it make sense to move your money out of the TSP into an IRA? Teresa said that's part of a larger conversation about how the TSP, the benefits of the TSP versus the benefits of the IRA. And by the way, Teresa, I have a whole article. If you're interested, you can look at my website. I have a whole article that explains the benefits or the differences between TSP and IRA. If you ask me, in the article, I list 14 differences between TSP and IRA. Of the 14 differences, I believe 10 of them advantage the IRA. So the IRA has the advantage most of the time. There are obviously exceptions. So I would encourage you to read that article, Teresa. If you go to my website, you'll see the article there, TSP versus IRA, and you'll see the 14 differences. Jennifer is asking, can you take a distribution solely from the G fund? No. Jennifer, your question is highlighting one of the shortcomings of the TSP. So Teresa, you should pay attention to Jennifer's question, okay? Jennifer is asking, Stefan, if I have the G fund and I have the which is my conservative bucket, and if I have the aggressive bucket in the stock funds, I cannot withdraw specifically from the G fund because the TSP is going to send me pro rata distributions. Jennifer, you are totally right, and we need to solve for that. And that's one of the advantages the IRA is going to give you. The IRA will let you be as specific as possible. So to solve it, Jennifer, you may need to move one of your buckets, whether it's the aggressive bucket, the conservative bucket. One of your buckets needs to be moved into or outside the TSP into an IRA. You could do both buckets as well, but at least one of those buckets. Okay, I see Nancy has a question. I'm retired, so I do not have any new money in my TSP. Everything I have is currently CNS. I hope that is correct. I do not need this money for at least 10 years. Oh, Nancy, you don't need this money for 10 years. Guess what? Market usually recovers in 10 years. Is it guaranteed? Not guaranteed. Has it happened 97.5% of 10-year periods? Yes, that's exactly what has happened 97.5% of 10-year periods of time. And again, that includes World War II. That includes Great Depression, Great Recession, dot-com bust, coronavirus, right? So all these things are included. So we have seen historical disasters in the stock market, and we also seen historical recoveries. So that is the type of thing which, if you've learned history, you see that history has this tendency to just, go and repeat itself to some degree. Now, anybody here who's saying, Stefan, this is going to be different. This is going to be different. I think the onus is on you to prove why this is going to be different. Again, we've had situations. We've had high tariff situations. We had high inflationary situations. We had world wars. We've had pandemics. We had many situations which disrupted global economies. So I'd like to hear why this is going to be different. Ryan is asking, if currently maxing out the TSP contributions, does it make sense to reduce contributions by a percentage or two in order to hedge against tariff-based inflation, or just to keep investing to the max? Well, Ryan, that's going to go into your personal cash flow. Do you need extra money to pay for your groceries? So that is that's really a personal consideration. So I see Pankaj is asking, why should we not prepare for the Japan's 34-year market underperformance? I think the difference is, Pankaj, that Japan and America is very, very different. The business friendliness nature of America, the fact that America does business all over the world. Okay. So I mean, it is a different economy. If you want to say it's the same thing as Japan's, I think that it's upon you just to say, look, why is it the same thing? The American economy is very, very different. We have different laws, different government. We also have companies doing business all over the world. We're the largest consumer in the world. So yeah, it could be that it might be similar, but I think that there are differences. And so if you look at those differences, that alone should answer your question. Matt, how does the TSP handle fund transfers? If you want to move money from G fund to S fund, does TSP sell your assets and then buy back that the allocations you requested? In effect, does it lock in those losses? Well, I mean, if you're selling from the G and you're buying it to the S, you're going to be buying the S at the lower price. So I don't know if, Matt, maybe I'm not understanding your question. The S fund is the one that had losses. So if you're selling G and going to S, you're not locking in losses. If anything, you're locking in gains that you had in the G fund. Selena is asking, retirement, 7 to 10 years out. Currently 100% of the contributions 2030. I would like to increase contributions. Should I maintain 100% to the L2030? So Selena, if you're talking about your future contributions, so to me, future contributions are the C fund and the S fund. Those are future contributions. That's what I tell everybody. As far as your existing balance, Selena, you're 7 to 10 years out. So you probably don't need to have as much conservative money as the L2030 would force you to have. The L2030 is probably going to have half your portfolio conservative. You probably don't need that. So Selena, there's really two things. One is your existing allocation might not be correct, but your question was more on your future contributions. Your future contributions, this is what I tell all my clients, future contributions should be C fund, S fund. Those are the future contributions. Fantastic, amazing, unbelievable. Okay, so great to connect with you all. As I mentioned, I'm happy to connect with you guys one-on-one. You could meet with my asset management team, and we could talk to you about how we would position your portfolio. It's going to be customized and very specific to your situation. I'm sure you're hearing from this presentation that my clients, they usually have a customized portfolio. It's going to be two buckets, but in general, their buckets are going to match exactly what they need from their investments, at least for 10 years. Okay. Also, let me just remind you that this stock market downturn, we have seen downturns in the past, and it does take time to recover. Sometimes it happens sooner, sometimes it happens later. I know everybody's saying the sky is falling and we should prepare for the worst situation ever in the world. I'm just questioning, why should this situation be different than every other situation the American economy has encountered? Okay? Fantastic, fantastic, fantastic. All right. I wish you guys much blessing and success. I know everybody's nervous. Everyone's uncomfortable. I'm nervous. I'm uncomfortable. This is a lot of pressure for me. All right. I have clients that are reaching out to me on a daily basis. I have non-clients that are talking to me as if they were clients of mine, and they're demanding answers. And I'm trying to help as many people as I can. But I would encourage you guys to meet with my team, and we'll get you squared away. But I also want to just let you know that my clients are going through pressure. I'm definitely having conversations with them. And I want you to know that I as well am invested in the stock market. My wife is a federal employee. She has a TSB. She has her money in the C fund and the S fund. We have not traded out of that. We're not moving to the G fund. Okay. My own personal portfolio, I'm not moving my money to the G fund. Okay. You're right. It stinks. It's very painful. I do not like it. I'm very uncomfortable. I'm under a lot of pressure because of the RIFs, the VEROs, and now to add this on top of this, it's definitely putting a lot of pressure. And this is what I signed up for. The business that I signed to be in is to be helped clients make these financial decisions about their federal benefits, about their investments. And so anybody here who's looking for this type of help, where you have somebody to talk to about your financial decisions, about your investment decisions, that's exactly what we offer. And I would encourage you guys to take me up on the offer to meet my team. If you're interested in meeting my team, just follow this link that I'm pasting in the chat box. Here it comes again. There it is in the chat box. So whoever is on the call, go ahead, click that link, and I look forward to connecting with you offline. Hang in there, everybody. Really, really appreciate it. There's a lot of pressure on everybody, and just remember that the market rewards patience. All the best, everybody. Wishing you well. Take care.